Welcome to the Real Estate 401k Show. Here are your hosts, Ryan Gertis, Mike Weinstein, and Justin Frederick, helping you build a legacy of wealth through real estate. Powered by the Recon Group at West USA and the Frederick team with Fairway Mortgage. NMLS number 625918.
Well, on occasion, it happens. That shiny squirrel, we take a look and we just start running. And last week, and we encourage you guys to go back into an earlier podcast, which we did just on the acquisition of land and all that goes into acquiring land. The intent of that podcast was to be about constructing and building construction and loans and things like that. And so this is going to be a little sequel to it. So let's just jump right in. Justin, I buy a piece of land, and now I've got to pay for the land, and two, I've got to pay for construction of that. How does that work? What are your recommendations? And walk us through that.
So you don't actually have to buy the land initially. A lot of people think that you have to start off by buying the land, close on the land, and then you can start the construction process. You could actually do the whole process together. I mean, it's a little bit, you're jumping into a lot of work initially, especially after you listen to the land podcast of how much goes into going through that land, the inspections and the civil engineering and all kinds of testing.
It's daunting, right? And overwhelming.
It is. It's a lot. I think it comes back to everything. You just got to have a plan. But you can buy the land and have your full budget put together for the purchase of a home or the construction of a home, all for 5% down. Okay, meaning all that costs together, you can put 5% down. Now that's up to $1 million.
Including, then that would mean financing the land as well.
Correct.
Okay.
Correct.
Because typically, Ryan, we're kind of, I'm not going to say taught or trained, but the main train of thought on this is you typically just don't go out and get financing for land by itself. You typically want to pay cash for land. Not to say that there aren't finance options, but not necessarily going to be the best rate terms and rates.
Yeah, that's been the typical kind of path for most people. So where did that myth come from? And
well,
and
Ethel from Sun City.
Right.
When you're dealing with construction loans, it's not your typical, not in every case of Fannie Mae or Freddie Mac or your conventional type of loans. A lot of times you're borrowing portfolio money, and portfolio money meaning banks' money. And with that portfolio money or banks' money, you're getting their set of rules, what they feel like is good terms or good for them and good for their customers on what they're going to offer you. So they're not standard rules across the board. You may come up with one bank that's offering you, well, you're going to need to put 20% down up to conventional loan limits. You may come up with a bank. Recently, I had a customer who did 10% down for up to $1.5 million construction, including the land.
This is I don't know about you, Ryan. This is like a game changer for me.
It can change be a game changer for a lot of people, because that's the biggest obstacle is, what's the money part of it.
Correct.
And
that's the biggest part of it. It's managing that budget and building a property that you really want, right?
Right. And so how does all that play into let's just say I were to go buy like $1 million piece of land, but I only want to put, basically $1 million build onto it. Are they still going to assess it the same way, or are they going to change the numbers up on that? Or how does that work?
Well, they're going to assess it by getting your land, making sure the value. And that's hard to say, but as long as it all comes through on the appraisal that it's going to add up, it'll work. It will work. There'll be a product for it.
But you would have to have you've got to be almost ready to build. I mean, you got to have blueprints, and you've got to have.
Not necessarily.
Okay.
And I'm just going to use my purchase for an example. We weren't even in the market to build a property. We were looking in a specific neighborhood, and when we found this piece of land, which the owner broke up into 3 parcels, and we didn't know it was happening, but when it happened, he put it on the market immediately as 3 different parcels. We were like, well, we want this piece of property. We had always looked at that piece of property. So we just jumped on it right away. And luckily I'm in the business, so I knew where to find my construction loans, and went straight to my source and was like, this is what I want to do. We gotta put this all together. And she's like, well, you need a longer close of escrow. And luckily, typically on land, we're getting longer close of escrows.
Right.
And that gave us enough time to do everything we needed to do on the land, start our process of architectural engineering, and close on the land and really get our plan put together. And we closed on the land by closing on the construction loan. So we had the basics, but we were able to make adjustments to the construction loan as we actually started getting bids. So we didn't have our full bids in by the time we closed on the construction loan. We only had a base price that we were estimating it was going to cost.
So then, are there like payouts because if I got a piece of land, let's say $500,000 piece of land, and I got a $500,000 build, and I close, I'm not needing the entire $500,000 to build portion of the loan yet.
There's draw periods.
Gotcha.
So there's initial draws, which would be maybe possibly your land, your permits, your engineering. You can finance all that stuff. Now, based on how much stuff had to go into that, I wouldn't suggest going that route, because you're putting a lot of effort into third parties to get you everything that you need to get that done. I would highly suggest, to make the process a little bit smoother, I would, if you have the funds to, buy the land, do your architectural, get your engineering done, and then get your construction loan. That's ideal, because it gives you more time for figuring out your speed bumps, per se, or figuring out, we want to make this change, and not just jumping into something, going right after it without having a time to look at it. Does that make sense?
Yeah. So I guess my question to that is, do they care about cash out of pocket or equity? What I mean is, like, let's say I were to either get a really good deal on an acre lot or whatever, or maybe it was bequeathed to me, and I paid nothing for it. But then I turn around and I say, well, this piece of property is worth $500,000. Is the bank then going to say, well, you don't have any skin in the game, so we're not going to give you $500,000 worth of value out of it, because you didn't have to come up with that cash out of pocket?
Good question, and it's all about that appraisal and what it comes the completed property and what the value is of that completed property. That's what they'll allow you to work off of.
Got it. So if I was given that $500,000 piece of property and I needed $1 million to build, and the appraisal said that it was worth $2 million whenever it was said and done, I could conceivably come out of pocket with no money and build that
No,
property?
You're still going to have the down payment, the minimum down payment. So I believe at $2 million, you're going to have, at $2 million total, you're going to need to have 15% down in order to make that. I believe it's 1 million, up to 1 million, I believe is 5% down, which I have a person for, up to 1.5, 10% down, and then up to 2 million is 15% down.
All right, if you'd like some more information about building on land and construction loans, we want to encourage you to text the word LAND to 623AZ-RECON. Again, text the word LAND to 623AZ-RECON. Ryan, I don't know if you had another question, but definitely feel free to jump in. But, most of us are typically familiar with, I'm going to go out and buy a home and get a conventional product, an FHA product, and if you've served this great nation, thank you for your service, but maybe some sort of VA product. What are some of the nuances and what are some of the differences between saying, here's a home at 123 East Main Street, 4 bedrooms, 3 bathrooms, it's already constructed, I'm going to put 5% down and get a conventional loan, as opposed to now, here's a piece of land I want to build. I need to get a construction product. What are some of the nuances, some of the differences, whether it's qualifying and so forth?
Well, as far as qualifying, you definitely need to have reserves. They look for a good amount of reserves to make sure if there's anything that comes up along the way that wasn't expected, they want you to be able to fund that difference because they don't want to come out and not have a completed product by the end, right? Also, you're typically going to get an arm through the build period. And typically it's an interest-only product with that arm during your build. But you're going to want to refinance that after everything's said and done. And some of the construction products come with a one-and-done close. So you'll close on the build, you'll be interest-only with an arm, and by the time you're done, they're refinancing you with the same information that you had for free into a 30-year fixed note. I feel like those are the biggest things as far as the qualification purposes, because realistically, debt-to-income ratios are pretty much the same. Down payments are pretty much the same. It's the reserves and knowing that it's interest-only in an ARM product.
So the experience that I have, the majority of the time, the way that the draws work is, let's just say, phase one is $100,000. That's going to be civils. That's going to be architecture, maybe some dirt work, maybe a little bit of, utility stuff that comes out to $100,000. Generally speaking, I had to come up with the $100,000, and then once that work was completed, the lender came out, made sure that the work was done, and they reimbursed me back the $100,000, and then I rinse repeat until the project's completed. Is that how it's working over there with the products your downline?
What we're seeing is the GC gets all the invoices from the companies that are subbing out the work. Once they receive the invoices, they're actually submitting back the invoices on the budget sheet, showing what the first draw is going to be, and then the GC receives the money, and then the GC distributes it to the other subs.
So is the GC with these products, are they getting paid up front so that they can go purchase materials, pay guys, and kind of get the ball rolling? Or are they getting paid after the whatever that schedule was for has been completed?
There's a percentage up front that you can take for materials, so that GC can hold those funds and use those with the subs as they go on. So obviously after they're being reimbursed for the first set of subs, then they still have that money left over from the initial draw that they can use for the other subs that are coming in afterwards.
Got it.
Well, I don't know whether either one of you really can answer the question, so I'm going to throw out a question that we may have to revisit another day. But I'm throwing it out there because I need to put you on notice, Curtis. We need to get Danny in here and talk about the GC element. But how do you figure out who's a respectable and a good GC or not? Because if the GC is collecting all of these invoices and the bank's paying the GC, and then the GC up front, and the GC skips town, it's got to happen frequently.
I feel like it's got to happen. I've never heard of it happening myself with my clients, but the bank does work on these GCs. I would also highly suggest reading reviews, no matter who's referring you this GC or where you're finding them from. I would read reviews on these GCs because, as we all know, typically you're not getting what you're paying for a lot of times out of these GCs, and you're ended up having to do a lot of work on your own. I was lucky, my GC, really good friend of the family, so right there all the time and helped me out and was on pace the entire time.
So my answer to that, and there's probably more to it that I'm missing, but it's been making sure that they're license bonded.
Sure.
But then checking into their insurance and making sure that you have construction insurance on it, because it may not be that they skipped town. They could have gotten in an accident. There could have been some type of unfortunate event that went down that makes it so that they can't show up, and it may not be nefarious at all. It just, life happens, right? And so in case something like that happens, is there an insurance policy backing up the losses?
Yeah.
Not only the construction losses, but the losses of time, because you as the consumer, the one that's actually forking out the dough, that time is money. And I know that's an age-old proverb, but at the end of the day, it's real when you're literally forking out cash and you're seeing no progress done on your development for month over month because someone got in a wreck or, God forbid they didn't show up or just skipped town with a $50,000 draw. So definitely vet your contractors.
Yeah.
Make sure that they have the documentation, the insurance, and the reputation and reviews to back it up before you go signing on the dotted line with them.
Well, the bank's definitely going to make sure that they have the license, the bonds, the insurance that they need to carry. Because one thing we all know, the people that have the money, they're going to make sure that everything gets done correctly so that they don't lose in the end.
It's good to have the money.
Yeah.
It's good to be king.
Yeah.
All right, if you'd like some more information about the construction process of actually acquiring a piece of land and building on that piece of land, Justin definitely is the resident expert. All you got to do is text the word land to 623-AZ-RECON. That's the word land to 623-AZ-RECON.
Thank you for joining us on the Real Estate 401k Show. If you want more information on how to build wealth, click on the link or text us at 623-297-3266. That's 623-AZ-RECON.